On March 26, 2025, Dollarama has announced its acquisitions of the largest Australian discount retailer in an all-cash deal. But what will be the impact of this transaction on the value of the largest dollar chain company in Canada? This is what you'll discover in this video, where I'll make a full stock analysis on the company Dollarama with the ticker DOL. To determine whether or not this company is currently under or overvalued, I'll first check out at their business model. So how are they able to generate their income and how their latest news will affect them in the long term? And then we'll make a quick fundamental analysis followed by a price prediction to determine what is the true intrinsic value of this company according to different valuation models. So without losing too much time, let's get to it right now. Dollarama is a Canadian dollar store retail chain founded in 1910, initially under the name Rossi, before growing to 44 stores by 1992. At that year, the owner, Larry Rossi, opened the first ever Dollarama in my father's hometown of Matane in Quebec in Canada. Back in the days, the mission of Dollarama was to offer a vast majority of different products to their consumers at the lowest price possible. In fact, it was called Dollarama because they were selling products under $1. Over the years, however, the problem of inflation came and affected obviously the value of these products, where nowadays we don't find a lot of products under $1. But this hasn't stopped them to grow their business as much as possible all over the country, where they now have over 1,600 stores in every provinces of Canada. And even if they are not able to fulfill their initial promise to offer products under $1 to their consumers, Dollarama is still the place to go in Canada if you're looking to buy different products at the cheapest price possible. Add to this, over the past couple of years, Dollarama has made some interesting acquisitions into the Latin American market. Last year only, they've actually increased by 10% their stake in the Dollarcity company, which makes that their total stake is now worth over 60% of the total company's value. On their side, Dollarcity is an American retailer that is operating all across Latin America with over 500 locations. So up to very recently, we've seen that Dollarama has decided to stay into the American soil, but in March of 2025, they've decided to make a bold move. Indeed, they've just acquired the Australian company, the Reject Shop, for a deal estimated to about $233 million. This acquisition comes during a period where Dollarama is looking to expand the scope of the operations across the international markets, where they notably have the objective with the Reject Shop to grow their total stores to about 700 stores by 2034. For instance, this Australian company currently has 390 stores, which makes that if this objective was to be fulfilled, it would mean an increase of close to 80% in 9 years. Usually, these types of acquisition in the short term will tend to make lose value of the company that will be buying the other company. So in that case, it would mean that Dollarama would be losing some value in the short term because they would need to pull out a lot of cash to pay out this transaction. But surprisingly, we've seen that it hasn't necessarily been the case with Dollarama the days following the transaction. Nevertheless, knowing that this transaction has been said that it was going to be an all-cash deal, meaning that it won't be financed by any debt, it means that it will greatly affect the current liquidity reserve that Dollarama has of slightly less than $300 million, where this acquisition will be fueled by about 80% of their total cash reserve. Another important factor for any companies that is looking to make important acquisitions is their financial strength. And so in the case of Dollarama, we can see that over the past 4 quarters, they've been able to outperform the analyst expectations 3 times out of 4. And despite underperforming the analyst expectations over the past quarter, we've seen that they've been able to increase their total sales as well as their total net earnings year over year throughout this last quarter. And at the same time, they've also been able to open 18 new stores throughout that same quarter, which represents 2 more openings compared to the same period 1 year prior. Globally, this makes Dollarama pretty interesting because it is a business that is offering pretty much essential products to their consumers at the lowest price possible. And with the numerous forecasts of a potential recession that could be lurking around the horizon, this would mean that this type of business would be pretty valuable for any types of investors. It is why Dollarama has gained slightly less than 50% of value over the past year only. only. But with that much growth as we've seen lately, is the company is still undervalued right now? This is what we'll discover right now by doing a quick fundamental analysis. Since the end of 2023, we can see that Dollarama's value has been quite importantly increasing to now worth over $42 billion. However, on the upper end, you can see that their price-to-earnings ratio also significantly increased throughout that same period to reach slightly over 38 right now, which would indicate that this company at the moment regarding this aspect would be overvalued. However, profitability-wise, we can see that they've been able to achieve some great profit and operating margin, as well as an incredible return on equity over the past 12 months of over 138%. Over that same period, they've also been able to generate some revenue of over $6 billion with some revenue growth in their latest quarterly revenue of over 5%. And the growth has been pretty similar in terms of their quarterly earnings growth over that same period year over year. As I mentioned earlier, this company doesn't currently have a lot of cash, only about $292 million compared to a gigantic debt of over $4.6 billion, which makes that they currently have a debt to equity ratio exceeding 369%, and which will also make that their more recent deal will cost them a vast portion of their total cash position. Now, to determine what is the true volatility of this company, as always, we'll use the beta on a 5 years period. And with a beta of less than 0.50, we can understand that usually this company will tend to fluctuate about 2 times less than the global market. However, over the past 52 weeks, we can see that this company has been massively gaining over 48% of value, while the market on its side has only gained about 6% of value. And at the same time, Dollarama is currently distributing a super low dividend of only 0.24%, which, however, doesn't represent a lot of their total net earnings, where their payout ratio is less than 10%. Finally, to see what is the true intrinsic value of this company according to different valuation models, we'll first start with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the PE ratio. And so with no surprise, since this company isn't giving any big dividend and that it currently has a pretty high price to earnings ratio, its current intrinsic value would be indicating that the company would be massively overvalued right now. Regarding the second model, which is the dividend discounted model, unfortunately we won't be able to use it since we can see that our average growth rate is bigger than our weighted average cost of capital. But then for the third model, which is the discounted cash flow model, where we will simply discount all the future free cash flow of this company that are predict for the future to find what is our enterprise value. We need to first find what is the cost of debt, the cost of equity, and the cost of debt and equity to find our weighted average cost of capital. And with this WACC, we can find that our intrinsic value at the moment would be currently quite undervalued compared to the current price of Dollarama. Finally, for the two last models that I'll be using to find the true intrinsic value of Dollarama, we'll be using the Graham's original value formula and the Graham's revised value formula. And so with the original formula, we can find that the current intrinsic value of this business would be quite undervalued compared to its current price. But in the case of the revised value formula, we would find that its intrinsic value would be quite lower compared to what is current price, meaning that the company would currently be quite overvalued right now. As you've been able to see in this video, Dollarama has a quite interesting business model operating in an essential markets for many consumers. With the cost of living that has been going through the roof over the past couple of years, a company like Dollarama is pretty valuable for many investors because it is giving the possibility to their consumers to make great economies. Valuation-wise, with the rapid increase in the value of Dollarama over the past year, it makes that many different valuation models are quite mitigate about what is the true intrinsic value of it. But personally, with the latest acquisition that they've just finished, it is giving me some interest to potentially invest in them depending on the quality of their next earnings report that will be reported at the beginning of April. Because at the end of the day, this type of transaction will help them to potentially massively increase the total earnings that they'll be generating in the future. However, in your case, if you're looking for other great Canadian dividend companies that could be some great addition to your portfolio for the rest of 2025, well, check out the video that's gonna be right over here, and I will see you soon. Peace.